Okay, let's look at the rectangle. I've taken the stock of AstraZeneca here, and again, I've chosen 2004 in which to display it. What is a rectangle? Well, it's a price trading range going sideways, drawn by two roughly parallel lines, where each time the price hits the top of the line, it tends to bounce off again, and so forth. Now, the rectangle isn't really formed until you've had the bottom and the top lines hit 2 or 3 times at least. The more often it's hit, the stronger the rectangle. Therefore, the better the signal will be whenever the price breaks out. Now, with a rectangle, you don't know whether it's going to break out at the top or at the bottom. So, how do we trade such a position? And, equally importantly, how important is such a position to traders? Well, the great thing about breakouts is, again, if you're like me, you're a trader, you're looking for a price direction. You're not trying to anticipate what the market's doing. You're not saying, is AstraZeneca going to make the next greatest drug for incontinence, for argument's sake? You're not trying to anticipate where the market's going. What you're doing is you're reacting. You're a reactive trader. That's what we momentum traders and trend followers are. So what we say is, well, if the price breaks below this bottom of the rectangle, I'll get in. If it breaks above, I'll get in, but I don't know whether it's going to break below or above, and I don't quite care. Okay, as a trader, where do you put your entry level? That's the first point. Because you'll notice that sometimes it can appear if it's broken through, but it in actual fact hasn't. So, first and most important thing to note, you can't make your entry point microscopically so close to this line that it might be a false breakout, as in here. The second thing is, this line is an estimation. Don't sweat it. Don't say, oh, should it be 1 millimeter lower or 1 millimeter higher? Should it be at the close or the very low for the day? And if it's the very low, then it doesn't form a perfect up. Don't be so anal. That's not what trading's about. Draw a rough and ready line, as I have done. The next thing is, make your decision, as I prefer to do, not just when the price falls one tick, one tiny bit beneath it, because it did there, and you might get in and out, but maybe a 2-day low. So first of all, it breaks through, and then makes the low for 2 or 3 days, and moves lower. So not only has it made a 2 or 3 day low, but it's actually gone low. Make it further out if you're not sure, particularly if it's early on in the pattern and you're just not sure whether the line is close enough or not. So for instance, in this case, you might have said, well, never mind a 2 or 3 day low, I want a 4-day low, because a 2-day low would be way too close. It wouldn't give me enough penetration beneath the line. I want a 3 or 4 day low. Here you've got it around here. That gives you some confirmation because you've had the price closing below the support level here for a number of days. You see here, it just didn't. It sort of broke half a bit, and that was it. If you at least had a 2 or 3 day low, then what you can see is that the price is beneath that level for more than a day, and that can be a good entry signal as well. You want the price beneath, you want it trading there for a short while, and then you get in. So don't worry about trying to capture this a few pennies here, because look, this is what we're after. The bulk of the move, which is some 200, 300 pence. I'm not too bothered about, oh, have I missed the first 10 pence or whatever. So let's say, for argument's sake, depending on who you are, your entry point might be here, it might be here, or it might have been here. You'll get a little bit sweaty palmed as the price moves and is a bit volatile here. Which brings us to the next point. Where do you put your stop loss? Well, remember my rule. Your stop loss only ever goes where you know you are wrong if the price goes there. So how do you know with a breakout to the south side that you are wrong, and therefore where your stop loss should be? Well, the answer's simple. Something north of this line. In other words, something up here, and I'll say what specifically and where in a second, would tell you that you're wrong. Because if the price is supposed to be moving lower, then it shouldn't be coming back up here. So that's where you put your initial stop loss. Of course, you'll move it lower and lower and lower as you go forward. But before we talk about how you move your stop loss, let's talk about where it should be on this side of the line for a second. Where should it be? Well, you can say that if it moves above this line to maybe at a 3-day high or a 4-day high, or starts moving into a trading range, that is your exit point. I like to play these things by ear because there might be a lot of positive news in which case I'll say, well, if it just moves one tick above it, I want to get out. Alternatively, it might be just more volatility, in which case I'll say, well, I'll let it go up a little bit higher before I make my decision. The important thing is, whatever that stop loss is from the entry point to here, I certainly got my downside projection a lot lower. Well, how do I make my downside projection? Downside projection for a rectangle position such as this tends to be the distance between these two lines here is projected downwards, and that's your estimated target level. That's a rough and ready measure. So in this case, for instance, where the stock has risen some 200 odd points, here it's supposed to drop 200 points down here, which rough and ready it has done, and so it's worked. That's how we work out what the downside projection is, and I certainly know that that downside projection from an entry point is far more profit, because I'm going to short the stock, than the loss I'd incur if it did move back up along here. Remember, with these positions you can only tell once it's broken out. You need it to have made the formation. The longer it's made it, the better. So in this case, 1, 2, 3, 4 times it's touched there, 1, 2, 3, 4-ish times it's touched here before it moved lower. Okay, trailing stops. Where do we put our trailing stops? There's no point in having a stop loss there and only keeping it there, because as the price moves down here, what do? You don't wait until it goes up there, otherwise you'll never make a profit. Now the kind of trailing stops I like, again, I play it by ear, I look at the news flow, I look at the overall market conditions, are they bearish? And I might say it's a 3-day high, or a 4-day high, or a 5-day high, and I might exit half the position at a 2 or 3-day high, and the rest at a 5 or 6-day high, and that's how I formulate overall trading on a breakout position such as this. Why do I like this type of position so much? Well, because it allows me to keep tight risk control, because the stop loss is just on this side. Secondly, it's reactive. I don't have to try and work out what AstraZeneca's biotechnologists are thinking. I'm just reacting to the direction in which the stock's going. So it allows me to follow the trend, it allows me to follow a breakout with risk management and risk control. That's incredibly important. If you've listened to the CDs on money management, then you know exactly how much money you should put into a particular trade based on the risk management aspects.